This is a multiple choice question about the financial sector, and it's asking you really what the financial sector lets happen. So the financial sector is the interaction of markets and their components within a regulatory framework. We know that the things in the financial sector that we have are banks, so retail banks for people to save their money in and borrow from. We also have commercial banks, which businesses use, and then we have investment banks as well, which deal with things like mergers and acquisitions. Then we also have insurance companies, and these, as well as building societies, all of these entities in the financial sector, they interact with people and with firms and allow them to do things. And all items in entities that there are in the financial sector are regulated. They have to follow certain rules. And the financial sector, this allows the government to increase the output of the Bank of England. This is definitely wrong. The Bank of England is independent from the government. And they are not really producing output, and the government are not affecting the output or whatever the Bank of England are doing. That's completely wrong. B, lending of money in the short run, but not in the long run. That's wrong, because banks can lend you money for a short period of time. So, for example, with an overdraft, if you want to spend more money than you have in your bank account at the moment, if you have £5 in there and you want to spend £10, you will go £5 into your overdraft. But usually that's for a short period of time, and then you'll pay back the money. But you can also, from a bank, you can take out a loan in the long run. For instance, a mortgage to buy a property. So lending of money in the short run but not in the long run is wrong, because you can take short-term loans or long-term loans. C, operation of money as a medium of exchange. Remember, money being a medium of exchange means that it's something which is agreed upon by people, that is something that can be used in exchange for products. So if you buy a good or a service, you can use money to pay for it. But that's not as a result of having the financial sector. This is something that happens if people agree that they're going to use money as a way of exchanging products. The financial sector then operates when we have money in existence, but allows the operation of money as a medium of exchange is not right. That's to do with people agreeing, parties agreeing that this will be the case and having confidence in money. D, saving of money by individuals and the investment of money by firms. This is the right answer. Be careful, what they've written here I think is a bit confusing. The financial sector does allow saving of money by individuals, definitely. This word here, investment, sometimes some books use it a bit loosely. Usually in economics, when we use the term investment, we mean that firms are buying capital. That's what we mean when we say investment. But a layperson, somebody who's not just studying economics, might use the word investment to mean saving money in a bank. So I'm not quite sure what they mean here, but if they mean to save money in a bank, then financial institutions do allow firms to do that. If they mean it allows firms to buy capital, which is what we in economics mean by investment, then yes, that's also true, because firms can earn interest in the bank on their profits, and then they could use that to buy capital. And also firms could take loans from the bank and use that to buy capital. So that would also be true. So the answer is D.